Alright, so today I want to make a video about a company I've talked about before, but I want to talk about it again because I think it's a really good company, and even though it's basically at an all-time high right now, I still think it's undervalued. So this is Carlisle Companies. First things first, if you liked the video, please like and subscribe. I really appreciate that. Getting right into it, $21 billion company. Engages in the manufacture, design, and building of envelope products and energy solutions. So they have two segments, Carlisle Construction Materials and Weatherproofing Technology, single-ply roofing products, warranted roof systems and accessories for the commercial building industry, including ethylene, propylene, diene monomer, and thermoplastic polyethylene. I'm not going to try to pronounce those things. So they're involved in those kinds of building things. If you look at analysts, the average analyst basically is assuming that it's fair value where it's at right now. I'm going to get into why I think that that's maybe a little conservative. It has a free cash flow yield of 5% and an earnings yield of about 6.5%, which is very, very good. Getting into the insights here, profitability is very, very good on this company. 37% gross margin, 23% operating margin, 27% net margin, 21% free cash flow margin. Return on equity, return on invested capital are also both very good. The growth is slowing a little bit right now, so that is something I'll get into a little bit later. But it is a very strong balance sheet. The current ratio is almost 3. They're buying back shares, they're buying back like 3-4% of shares yearly, which is crazy good. Earnings are projected to go down a little bit next year. However, revenue is still projected to grow nice. Dividend, I'll get into that later. It is below its historical PE by a lot, also below its historical price of free cash flow, which I'll get into. Getting into the financials here, if we look at revenue, they've grown revenue about 6% per year going back, which is decent. It's not great by any means, but there definitely is a clear uptrend. If we look at shares outstanding, is where it really shines. Like I just mentioned, I mean, you go back the year ending 2014, they had a little over 65 million shares outstanding. They're down to 50 the year ending 2023. So that is a lot of shares being bought back per year, which is something that I really, really like. If we look at earnings per share, also has gone from 3.61 the year ending 2013 to 15 the year ending 2023. So that's about 5x their earnings in a matter of a decade, which is very good. If we look at the balance sheet, they have about just under $4 billion in debt on a $20 billion market cap. That's pretty good. That's nothing to be worried about there. If we look at its metrics, also has gotten better. A free cash flow margin of 23%, operating cash flow margin of 26%. Those are both very good. If we look at return on assets, 11%, return on equity, 27%, return on invested capital, about 17%. Also, those are both very good numbers. Free cash flow per share has gone up very nicely. It's gone very high. 21 the year ending 2023, the year ending 2013, 4.69. So you're talking about roughly 4 or 5x there. So also very nice growth. The current ratio has never been below 1.84 in the last decade. So very good there. Another thing that's very good here, the dividend. The payout ratio is up just under 14%, and they're growing it, the 10-year average and the 5-year average, just under 15% per year over the last 3 years. So they're actually growing it faster. So that's something I really like to see. If you'd have bought this company a decade ago, you'd have a yield on cost of about 4.8%. So that's very good to see, and that's exactly what I'm looking for when it comes to a dividend. I've said time and time again that the current dividend does not matter, and frankly, it's kind of irrelevant, because if you're a long-term investor, what you are worried about is what's going to be the yield down the road. Because if you're buying a company today and your goal is to hold it for 10, 20, 30 years, you don't care about where it is right now. You care about where it's going to be down the road. And that's exactly what I like to see from this company. If we go back, let's go back a decade, just out of curiosity here, Actually, it only goes back to 2005. So you'd be 12.85%. So you hold this company, you'd have over a 12% yield on a company that's still growing nicely. So that's exactly what I'm talking about there. So I think we've established fairly good company. The question is, where is a good price? So when you go back a decade, they've grown revenue 7% per year. They've grown their return on invested capital 5% per year, which is very nice as well. They've grown earnings per share about 21% per year. Free cash flow, they've grown about 20% per year, roughly. Operating cash flow, 15% per year. The price to earnings, the price to operating cash flow, and the price to free cash flow has actually gone down, at least when you look at their compounded annual growth rate, meaning the earnings for this company have grown much quicker than the S&P average, but the actual premium that people are willing to pay has gone down, which is another thing that's good. Now, I don't think that it's going to grow as fast over the next 10 years as it has over the previous 10 years. I think that's a fair assumption to make. However, if you look at its valuation here, so this is assuming that this is going based on earnings. This is assuming they grow their earnings by 10% per year, which, if anything, I think is conservative. They grow their shares outstanding by they buy back 2% of shares per year, which is less than the 3% per year they've done historically, and they grow their dividend 12% per year, which is less than the 15% they've done historically, and they trade for a 15 price to earnings, which is less than what they've done historically and less than the S&P average. That still assumes that the fair value is about 25% above where it currently is. I think that it's undervalued. Do I think that it's 25% undervalued? That might be a little bit aggressive, but I think this company definitely is undervalued. So, long story short here, I think this company is definitely a buy where it's at right now. Would I take a full position right now? Not necessarily. I might wait for a little bit of a pullback, but based on these numbers, and I don't think these numbers are aggressive necessarily, I probably would be comfortable taking a full position where it's at right now. That doesn't guarantee it's going to go up in a straight line, though. But I think that these numbers, if anything, they're conservative. And I was fairly conservative when going about coming up with these numbers. So I think that this company definitely is a buy right now. I'm dollar cost averaging right now. I'm not necessarily taking a 2, 3, 4, 5% position right now. I'm very confident dollar cost averaging right now. But you also have to keep in mind that earnings are projected to scale back a little bit. But over the long run, I'm still confident. So anyway, that was CSL, Carlisle Companies. Like I mentioned at the start of the video, if you get value, please like, comment, subscribe, all that good stuff, and stay tuned for more.